When you think of some of the most famous investors in the world, Warren Buffett is the first one that comes to mind. And in today's video, we're going to be talking about the one single index that you can invest in to literally make you a millionaire. Now, for Warren Buffett, he advises the average person to stay away from picking stocks, which is exactly what I do. I will not, and I do not carry any individual stocks in my portfolio. I don't want anything with essentially exposure to one single company, which is the reason why I do invest in ETFs and only in ETFs. Even at the Berkshire Hathaway meeting, they said, in my view, for most people, the best thing to own is the S&P 500 index funds. But why is that? Why should people only invest in the S&P 500 when we look at the diversification and everything else that we have within the investing world? Why should we stick to one single index? Big point of this is the power of time. Despite the success, Buffett has made many investing mistakes throughout the career, and a lot of these can be traced back to when he started buying stocks. And essentially, he started at 11 years old. If you've ever watched any of the interviews with him, he bought a couple of shares of a company for $114, which would be equivalent to about $2,200 today. However, if he took that same $114 and invested it into the low-cost S&P index, over the same amount of time from being 11 years old, he would have over $400,000 today. That is right, guys. The power of time, the power of compounding. $114 then would be equivalent to $400,000 in the S&P 500 today. Now, of course, Buffett's story shows us exactly the growth of the American stock market and what we've seen on the investing front. And of course, 90% of his estate is going to go into the S&P 500 when he passes. So you talk about someone who is absolutely tried and true to really growing not only the S&P 500, but American companies themselves. He is putting 90% of that $131 billion into the S&P index when he does passes. So why is it, again, just focusing on one single index to put your money into? The average person cannot pick stocks. And again, shared at the 2021 shareholder meeting, Buffett told the investors, I don't think the average person can pick stocks and really understand them how they used to be, which is the reason why he advises a majority of individuals just to invest in an index such as the S&P 500. To give you a rundown really what the S&P 500 is, it is the 500 largest publicly traded companies in the United States, and it includes 80% of the American equity market. So when you start looking at market cap by value, this covers 80% of the equity market. So when you buy the S&P 500, essentially you're investing in the growth of the United States economy over time, and history has shown that is a very good bet. Now, this is also one of the reasons why I do not invest at all with international stocks, international ETFs, anything of that nature. Is there's a couple kind of things that come out of this is not knowing, exactly the companies that you're investing in, what countries you're investing in, exactly what they do. There's a ton of research and honestly time that goes into really evaluating individual companies. And if you remember how Warren Buffett did it, he would spend hours, hundreds of hours, thousands of hours doing research for companies to find the value before he invested in them. For a majority of people, we don't have that time or do not want to dedicate that much time, which means the S&P index is an absolute perfect fit. So how to invest in the S&P like Warren Buffett? Buffett knows from the experience, from his personal experience, it can be very hard to buy an index like an ETF and hold it for decades. This is the big part where we get back to building wealth over time. If you're investing and you're talking about 2, 3, 5 years, that is not a long enough time frame to be investing. When you start investing in something like the S&P 500, we're talking 10, 20, 30, 40 years versus just the 2, 3, 5 years that a lot of people do see. Now, the S&P 500 has an average return of 9.24% over the last 150 years. Now, again, when you think of high yield savings, when you think of CDs, when you think of the longevity of the S&P 500, 9.24% over 150 years. Now, of course, there are going to be up years, there are going to be down years, but all said and done, 9.25 has been the growth of the S&P 500 over the last 150 years. Now, of course, with this, the S&P funds, you can get super cheap with very low fees. This is the big difference when it comes to earning, especially again, over that 10, 20, 30, 40 years, is because when you start looking at just buying something like a simple ETF, like the S&P 500, holding it for 40 years, investing in it on a regular basis, it is going to be a game-changing difference when you look at some of the fee structures, which we'll look at just a minute. So imagine investing $1,000 into the S&P 500. You're adding $50 every single month for the next 40 years. That is right, 40 years you're going ahead and investing, assuming that average remains at that 9.24. If you look at the difference between a 1% and a 2%, so literally a 1% difference over the course of 40 years can cost you more than $50,000 in fees. That is not only just on the fee schedule with that 1%, but you are also losing that 50K that you had out of there with the compounding factor that you're not going to be getting from that. And of course, this is based on 40 years. $50 a month we know is going to be what, $600 a year for 40 years. And again, it's going to be crazy when you start getting into the large compounding numbers. This is the reason why a lot of these S&P indexes are super cheap. So which one should you choose? Now, honestly, there are really two solid choices out there. The first one we've talked about, which is the State Street Spider S&P 500 ETF. The ticker symbol on this is SPY, and it tracks the index. That is all that it does. It tracks the S&P 500 index. And essentially, this is not managed because as they kind of change within that S&P 500, this is going to adjust to the companies that either enter or leave that S&P 500 index. And the other one, which is huge, is the Vanguard S&P 500 ETF, which is the VOO. Now, if you've caught any of my investing videos, these are the core ETFs of a portfolio. You could go for a little bit more growth. You could go for some dividends, which we do build out in our 3 ETF portfolio. But overall, if you just had a simple straight investment into either of these S&P funds, you would see a massive, massive growth over an extended amount of time. If you're putting money in here on a very continuous basis, it is going to be well worth it. Now, between these two, my perfect one and the one that I do hold in my personal portfolio is the VOO. That is the Vanguard S&P 500 ETF. Now, the big reason for this is the expense ratio. When you start talking about 1% to 2% being that $50,000 value over 40 years, the VOO has an expense ratio of 0.03, which means you're spending $3 on every $10,000 you have invested. And again, you're not paying a financial advisor, you're not paying an upfront fee, you're not paying a management fee, you're not paying literally anything. You can open an account with my link down below for M1 Finance. You can go ahead and set it to invest in that VOO. With contributions, they will be automatically invested into that VOO, that S&P 500, and this is going to make you rich. Now, of course, the higher the contributions, the faster it's going to grow. The higher the contributions, the more compounding you're going to see. When there's dividends in there, which it doesn't pay a high dividend, but overall, we're not really focused on that. We're more focused on the growth aspect and getting that 9.24% return year over year for the next 40 years. Because literally, you run this into a compound interest calculator and you will be absolutely blown away, even when you're just putting, let's say, $50 in there a month. And of course, if you're investing regularly, and I really advise the 401ks, the earlier that you can put money into IRAs, and even if you're doing IRAs, traditional or Roth variations, putting them with a company like M1 Finance where they're actually invested in the market versus sitting at your banks and your credit unions are going to be super beneficial for you in the long run, because of course, you're not only going to see more growth, but you're also going to have a lot cheaper fees. All right, guys, so that is going to do it for exactly how Warren Buffett would advise investing into the index, going in for that S&P 500. This will make you rich with regular contributions. And again, if you've caught any of my investing videos with the VOO, we are up about 60% in the last 2.5 years, which is crazy, through, of course, dollar cost averaging within the VOO. And that is where I do keep my index funds. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.